Hey guys, and welcome back to the channel. My name is Elizabeth, and recently I did a video on Cody Sanchez. I highly recommend checking that out. And she's incredible and has multi-millions and hundreds of millions of dollars in assets and in businesses. And she was in finance, and she talks about how the financial field tries to gatekeep and keep people away from this knowledge, and in hopes to keep them making more money and to keep other people from not making as much money and just from having that ignorance and not understanding. And so one of my goals here is to share information on a lot of different topics, but to empower you and educate you and inform you so that you are prepared and that you know how to handle life and to handle certain situations, and you could do more with your life. And so today we're going to be talking about some of those common financial terms that you might know, but some you might not know, like EBITDA. Have you heard of that? Let's go ahead and talk about all those things so that you have a basic foundation and understanding, and so you can understand everything and go kick butt in your life. Let's do it. All right, number one is amortization. It's a method of spreading an intangible asset's cost over the course of its useful life. So intangible assets, this could be a non-physical asset that is essential to the company, or it could also be something that is important, like a trademark. It could be a patent, a copyright, a franchise agreement. So amortization, all this is this intangible asset's cost and spreading it out over the course of its life. And it's an intangible asset, which typically is essential to the company, like a trademark, like a patent, like a copyright, like a franchise agreement. So you might have heard of some of those before, like you might know what a trademark is or a patent is for a certain product. And so that is what it is. So don't get so wrapped up in it. Amortization, what the heck is that? Let's simplify it. Number two, you might have heard about this before, especially if you're on this channel, but assets. So assets are simply items that you own that could provide a future benefit to your business. And so this can be cash. It's an asset that you have that can provide value to you. It could be inventory that you have. And so people want to buy it and purchase it. You already have all this inventory, these assets. You could have real estate. That's a huge asset class. That's really important. You could also have office equipment. It could be accounts that are receivable in business, which are payments due to a company by its customers. So they have these payments that are due. Those are assets because it's money that they already, they just haven't gotten in their hands, but someone has used their product or their services. And so there are tons of different types of assets, like current assets or fixed assets. And so these current assets are assets that can be covered within the year. It can be converted to cash within a year. So it's current, right? So within that tax year. But a fixed asset can't immediately be turned into cash, but they're tangible items that a company owns and can use to generate long-term income. And so assets are incredible. Assets are so important. I've read tons of financial books and have done a lot of financial research, and most wealthy people say that you need assets, and the more assets you have, the better. And some say as well, having cash flowing assets, which are awesome. It's just constantly giving you money and cash flow instead of just, hey, I have something that's worth $500,000 that just is what it is. But instead of like every single month, I have this asset that just pays me $5,000, $10,000, $15,000. It just flows. So that's an asset. Number three is asset allocation. So what's allocation? Basically, it's just asset allocation is how you choose to spread your money or allocate it to spread across different investment types. And these are asset classes. So they're different types of assets, like we talked about just a little bit ago, like real estate and businesses and all of those types of things. And so some of these asset classes can include bonds, it can include stocks, it could be cash and cash equivalents and more. And so bonds are typically, they represent a form of borrowing. So you might have heard of stocks and bonds. And so bonds, when you buy one, it typically is from the government or a corporation, and you're essentially lending them money. So when you buy a bond, you're lending them the money, and then you receive a periodic interest payment and you get back that loan amount over time. And so over the bond's maturity, which is the defined term that the bond can be redeemed. So that's what a bond is. It's basically a loan. And so you're going to get money back because you loaned a company some money. Also stocks. So a stock is a share of ownership in a public or a private company. So you are an owner partially if you have stock or if you're investing in stock because you partially own that company because you're giving them money that will help them with their business. And in turn, from the profits and the things that they make back, you're going to get that money back. And so when you buy it, you actually become a shareholder and you can receive dividends. So dividends is the company's profit. So if you ever heard of that, like profit is a little bit more easy to understand. It's the money that's made, but it's the same thing with dividends. Dividends is the company's profits. And so if and when they are distributed, you will get them. Then also cash or cash equivalents. So all this is cash or money or a thing that can be converted to cash quickly and easily. Number 4, this is incredibly common in business, but a balance sheet. And so a balance, what? Like, does it have some type of money on it? And so simply a balance sheet is an important financial statement that communicates an organization's worth, how much it is worth, what is its value, what is the book value, okay? And it includes a tally of the organization's assets. It also includes the liabilities or the debts, the shareholders' equity for a given reporting period. And so the balance sheet equation looks like this. Balance sheets are arranged according to the following equation. Assets equals liabilities plus owner's equity. Number 5, have you heard of capital gains or a capital gain? If not, this is what it is. So a capital gain is an increase in the value of an asset or an investment above the price that you initially paid for it. So if you paid $500 and then you ended up making $1 million off of it, that would be a capital gain. And so if you sell the asset for less than the original purchase price, that would be considered a capital loss. So basically it's just money, capital that is gained. So a capital gain is just you made more money, you gain more capital. Number 6 is a capital market. And so a capital market, this is a market where buyers and sellers, they engage in the trade of financial assets, including stocks and bonds. And so this capital market, it's going to be a trade of all of these different assets and things. And so the capital market can typically feature several participants, which includes companies, it includes institutional investors, it also includes mutual funds, hedge funds, and hedging. And so companies are simply firms that sell stocks and bonds to investors. And so this company is going to sell stocks and bonds. So like Apple, they sell stocks and bonds to investors like us who want to participate and be an investor in that company. Institutional investors is investors who purchase stocks and bonds on behalf of a large capital base. And so these institutional investors, they're literally just investors that purchase these stocks and bonds on behalf of somebody else. So on behalf of institutions. Mutual funds, a mutual fund is an institutional investor that manages the investments of thousands of individuals. So a mutual fund, it's an investor that manages thousands of people's investments. A hedge fund is another type of institutional investor which controls risk through hedging, which is a process of buying one stock performance. And so all of these terms are really incredible and interesting to know. And so I hope if you want to take notes on this, feel free. But even when I was learning some of these words, I'm like, I heard of this word, but I didn't know exactly what it meant. But it can really help you to understand the financial world and business a lot better. 7, we talked about this earlier, but cash flow, we can get cash flow from our assets, right? And so cash flow simply refers to the net balance of cash moving in and out of a business at a specific point of time. And cash flow is commonly broken into 3 categories. So we have operating cash flow, we have investing cash flow, and we also have financing cash flow. And so this cash flow is the money coming in and out. It's flowing, right? It's coming in and out. And so operating cash flow is the net cash generated from normal business operations. So any cash that comes in from the normal business. Investing cash flow is the net cash generated from investing activities, such as securities investments and the purchase of sale assets. So that investing cash flow is cash flow from investments. You can kind of see that in the name. And then financing cash flow is the net cash generated from financing a business, including debt payments, shareholders' equity, and dividend payments. Number 8, a cash flow statement. So we have cash flow, but there's a statement. A cash flow statement is in a financial statement that is prepared to provide a detailed analysis of what happened to a company's cash during a certain period of time. So it's going to give you a statement. It's going to give you an example and information on what happened. Where did the cash come from? What type of cash flow was it, etc. It's a statement with information on the cash flow. Number 9, I think a lot of you guys might have heard of this one before, compound interest. So compound interest is the 8th wonder of the world. It's incredible. And all it is interest on interest. And so when you invest over time, it's not that much money. If you invest in that Roth IRA, it might be the $6,000, $6,500, $7,000 a year, but eventually it compounds. And so that interest compounds and you get interest on your interest. And so when you're investing or saving, compound interest is earned on the amount that you deposited plus any interest you have accumulated over time. While it can grow your savings, it can also increase your debt. Compound interest is charged over the initial amount that you were loaned, as well as the expenses added to your balance over time. And so we actually talk about compound interest as a good thing if you are the one who's investing the money, but it actually can work against you. Like it just said, if you have debts that are owed, and so that interest compounds over time. That's how, like when you have a mortgage, you could pay so much on interest because it compounds over time. Number 10, depreciation. So depreciation represents the decrease of an asset's value. So we're talking about our assets again, it depreciates. So if it maybe was worth $500,000, now it's worth $400,000, that's a depreciation of the asset's value. Number 11, EBITDA, EBITDA. It's an acronym standing for earnings before interest, taxes, depreciation, and amortization. And so EBITDA is a commonly used measure of a company's ability to generate more cash flow. And so to get EBITDA, you would add net profit, interest, taxes, depreciation, and amortization together. And so you want to figure out what's that net profit. And so you use EBITDA, which is the combination of the earnings before interest, taxes, depreciation, amortization, etc. Number 12 is equity. And so this refers to the amount of money that belongs to the owner of a business after all assets and liabilities have been accounted for. And so this is an accounting equation. The shareholder's equity can be found by subtracting the liabilities from the total assets. And so you can do this in your everyday life. A lot of people figure out how much equity do I have, but you subtract. Number 13 is an income statement. And so basically it's a financial statement that summarizes a business's income and expenses during a certain period of time. And so it can sometimes also be referred to as a profit and loss statement. And so it's basically how much money has been coming in, how much profit have they made, how much have they lost. Another common one is liabilities. So liabilities is the opposite. It's what you actually owe. And so you want to have as few liabilities as possible, and there's different types. We have a short-term liability and we have long-term liabilities. The short-term or the current liabilities is what is due in the next year, and then the long-term would be for financial obligations that are not due for over a year, and it can be paid off over a longer period of time. 15 is liquidity. So liquidity describes how quickly your assets can be converted into cash. And because of that, cash is the most liquid asset because it's already cash, right? And so the least liquid assets are items like real estate or land because they can take weeks or months to sell. So the more liquid something is, the easier it is to be converted to cash, or it already is cash. Number 16 is net worth. So you can calculate net worth by subtracting what you own, your assets, with what you owe, your liabilities. And so the remaining number can help you determine the state of your financial health. So if you have a ton of liabilities, a lot more than your assets, then your financial health isn't as good. But if you have way more assets than your liabilities, then your financial status in place is a lot better. Number 17 is a profit margin. And so the profit margin is a measure of profitability that's calculated by dividing the net income by revenue or the net profit by sales. And so companies often analyze the two types of profit margins, which can be gross profit margin and net profit margin. And so the gross profit margin, which typically applies to a specific product or a line item rather than the entire business, but a net profit typically talks about the entire company. Number 18 is return on investment, or the acronym ROI. It's return on investment is a simple calculation that is used to determine this expected return of a project or an activity in comparison to the cost of the investment, which is typically shown as a percentage. And so this is an important calculation to figure out if it's worth it, or if it will be worth it, or if it was worth it. What was your ROI? People say, what is the return on the investment? So if I invest $500,000, am I going to end up getting earning or making 5 million, then that's a good ROI. But if I invested 250,000 and I lose 250,000, then that's not as good as of an ROI. Number 19 is a valuation, not evaluation, a valuation with a V. It's the process of determining the current net worth of an asset, a company, or a liability. So if you've watched Shark Tank or something like that, where they're trying to acquire businesses or invest in businesses, they will say, what's the valuation? Let's determine that. So it is the current worth of the company. And lastly, number 20 is working capital. And so it's also known as net working capital, but this is the difference between a company's current assets and current liabilities. The working capital is the money that is available for daily operations, and it can help determine an organization's operational efficiency and short-term financial health. And so if they have more working capital, then they're doing better. They have a lot more to work with, right? So that's helpful. All right, so those were some of the common financial terms or things you might have heard of or you haven't heard of or you just wanted a little more information on. I hope this video was helpful to you. I thought it could be a beneficial piece of information to put out there. So let me know in the comments below what you think, if you took anything away, or if you have any more financial terms or tips to add. Feel free to give this video a thumbs up and feel free to share and subscribe. Feel free to hit the notification, the bell at the bottom to be notified on more videos that come out, and I will see you in the next video. Bye guys, keep learning, working, and growing. You got this.